Okay, hello everyone. Good morning, good evening, depending on where you join us from. Welcome to the Gerhard Center webinar series. Today we have a very special guest speaker, Aunnie Patton Power. She's going to talk with us. She's going to lead today's discussion around adventure finance. Let me first, before I pass the floor to Aunnie, let me first introduce her. Aunnie Patton Power is the founder of Intelligent Impact, an innovative finance advisory firm and a university lecturer on innovative finance, impact investment, and technology for impact. At the University of Oxford Saïd Business School, she holds the title Associate Fellow and Entrepreneur in Residence at the Skoll Centre for Social Entrepreneurship. She's an adjunct faculty at the University of Cape Town Graduate School of Business, New York University's Wonger Graduate School of Public Service, and a visiting fellow at the London School of Economics, Marshall Institute for Philanthropy and Social Entrepreneurship. She's also a founding member of the Dazzle Angels, a female angel investing group, a senior advisor to Constellium Capital, and she sits also on the board of Global Access Diagnostics. A reformed M&A investment banker, Power began her impact investing career in 2010 with Unitas Capital in Bangalore and has since worked with startups, intermediaries, funds, family office, foundations, corporates, and governments across Africa, Asia, Europe, and North America. Power's work has been published worldwide, including by the Oxford University Press, the Stanford Social Innovation Review, the World Economic Forum, Impact Investing Policy Collaboration, and a massive open online course on Coursera. Her first book, Adventure Finance, was published by the Palgrave in 2021. So thank you so much, Aunnie, for being with us. We really appreciate you fitting us in your very busy schedule. Thank you so much. Over to you.
Well, thank you so much for the wonderful introduction. Lovely to be here. So I'm looking forward to today, but I'm actually going to start out by asking you all some questions. So I'm going to share my screen here. Here we go. And I'm going to actually, hold on just a second. There we go. I'm going to put a link into the chat here. So there we go. I'm gonna put that there. There we go. Anyone that would like to, I'm gonna do a couple of polls here. So I've just put a link into the side and I'm going to present this. Here we go. All right, I'm going to share my screen. There we go. Okay, so if you can go to either the link in the chat or you can go to minty.com and you can enter in the code here. And you can click the little heart there and I can see how many people are entering. I'm going to do a couple of polls to start out, and then we're going to do a few as we go as well, because I want to make sure that this session is as informative for everyone as possible. All right, got a few of you there. I'm going to go over to the first slide. The code is going to stay there at the top, and you can use the code in there. So there we go. All right, what is your first thought when you hear the term impact investing? All right, positive change at scale. I like that. Ooh, great, some great things there. Finance opportunity, a good, social good. Excellent. Local communities, innovation, Justice. Ooh, I like that. Justice. Lower market rate. Interesting. Opportunities available, emerging economies, social impact, sustainability, win-win. Social enterprises. Excellent. All right, I'm gonna let those keep going. Great. Make the world better, finding purpose. Excellent. I'll let a few more people throw in a few pieces there. So impact investing, the definition that we work with within the impact investing world is environment, opportunities, investments that create positive social impact in addition to financial return. So social and environmental impact. And encapsulating a lot of the different pieces, a lot of the different things that are mentioned here, including opportunities and finance, understanding that you are attempting to create social and environmental impact alongside your financial return. Now, my particular work within the innovative financing space is around financial structuring. And I'm going to talk a little bit about that. But before I do that, I'm just going to go to one more poll. So people have already started to fill this in. What would you like to learn today? So you guys have all signed in your mornings, afternoons, evenings to this webinar. I'd love to hear from you what you're looking to learn. So we can talk a little bit about what the ecosystem looks like in impact investing, purpose and profit, how to be more purpose driven. I can definitely talk about my methodology and philosophy. Raising funds for social enterprise, great. Absolutely can talk about that. Unique ways to deploy capital beyond traditional investment. Excellent. Monetizing social ideas. Ooh, that's a big topic. I like it. All right, I'll give you a couple more minutes to put some more pieces up, and then what I'm going to do. Yes, is there a way to put $10,000 to $100,000 into an investment, an impact investment? Yes, is the answer. We can definitely talk about that. All right, so we've got some people that want to learn about raising funds, some people that want to learn about allocating funds. Good to know that we're trying to do both of that. All right, you can continue to put in your requests for things that you want to learn today. I'm just going to unshare the screen quickly, but I'm going to keep it open on my other monitor here so I can see what it is that you guys are wanting to learn. Okay, so I would like to do that because there's so many different ways we can take this conversation. So I'm just going to speak for a few minutes on some of the topics that you guys have pulled up. And then I think Karaman has some questions for me, and then I'm happy to take more questions from the audience as well. So as I said, impact investing is around investments that create positive social impact as well as financial return. And my area in particular is around financial structuring. And what I believe very strongly is that how we allocate investment can be as important as what we invest in. So historically, impact investing has looked at essentially what type of investments should be invested in. And I like to think of 3 different phases of impact investing in the past 12 years that I've been in the space. So the first phase was very much can we do well and do good? So the very beginning of impact investing, it was an outstanding question. Is it possible to invest capital into good enterprises and actually make money? This seems relatively straightforward potentially now, but at the time it was an open question. And one of the big questions was what is the trade-off? So how much financial return do you have to give up to make social return? And really what happened is after a few years of seeing investors seek out positive social environmental impact, it started to be quite clear that there wasn't an inherent trade-off, meaning that just because a company was more socially or environmentally impactful, it didn't necessarily mean that that company was less profitable. This was interesting because it started to answer that question: can we do well and do good? Now, the second wave of impact investing a few years later really was kind of that from that jumping off point, which was, oh, wow, we can do well and do good. So what does this look like if we're thinking beyond trade-offs? That's something, a big report that was put out during that time. So we're going beyond trade-offs. What can we think about? And we think about ways in which, we can think about putting together portfolios of impactful organizations across different asset classes. And, that was impact investing was growing and changing. And really investors were saying, we don't have to have a trade-off. We can make financial return as well as social impact, environmental impact. Where I think we are today is actually in a third wave of impact investing. So to the question of how to make it mainstream, I think we're getting there. There are billions of dollars in impact investing now. In fact, the IFC recently, for their sizing of the market, thinks that there's about $2 trillion in impact investing now. That's at the higher end. The Global Impact Investing Network thinks it's about 700 billion. Either way, we're starting to get to very substantial numbers. On a regular basis, there are mainstream funds opening up billion-plus dollar funds in impact investing. So we're really getting to the mainstream, partially because of that kind of pushback to the idea that there is a trade-off. Now, having said that, I think at that same parallel time that this mainstream is happening, there's another movement at foot that I consider myself very deeply entrenched in, which is looking at where we're going and asking if it's the right direction of travel. So just because impact can be mainstream and we can make, great financial returns, top tier financial returns, and we can use private equity and venture capital and stock markets to do that. The question is that are those the right tools to really create the system change that we want to create? And part of this is understanding that there's significant amounts of inequality that are in the system. And so if we're just replicating the system by just adding impact onto what we're already doing, the question is, are we actually going to have the impact that we want to have? So where I sit to bring in some of these questions here is, how do we balance that purpose and profit? And one of the things that the book that I've written, Adventure Finance, is really trying to do is trying to bring the conversation beyond just venture capital and traditional bank debt for impact investors. So to the individual investor that asked about how you put $10 to $100,000 in, there are some great ways. So for instance, crowdfunding is a equity crowdfunding, debt crowdfunding. These are ways in which you can put capital into small businesses. The same thing with angel investing. Angel investing is also an opportunity to invest in. There's a growing number of impact angel investors that are looking and seeking out organizations that are creating positive social environmental returns, as well as investing in founders that have previously been excluded from the market, including women, people that are marginalized within communities. And so that is a piece of impact that impact investing can bring as well. So when you are as a funder looking to create impact, it's about seeking out the types of opportunities that are purposefully social enterprises. Now, when you're an entrepreneur wanting to raise funding, I'm just going to show a quick slide here. I just need to put it up. In my book, what I've done is I've created what I call the founder evaluation. And this is really where I think it's important for founders to consider who they are how mission driven they are, and what their funding needs are before they go out and raise capital. So I encourage funders that are interested in funding socially impactful businesses to really think deeply about the type of funding that they need. So some of the questions around who they are is, how is your company registered? Are you a nonprofit? Are you a for-profit? One of the things we often do is we write off nonprofits. Nonprofits can absolutely qualify for debt funding, can be able to actually have revenue. It's important to understand what stage the company is, what their growth projections are. Apologize for the dog across the street. How mission driven the company is, and understanding if the mission is embedded in the company, if it's a social enterprise, or there are ways in which the founders are really committed to this, if they have an impact track record, and then really dialing in the types of funding that is needed. And this is important for entrepreneurs as well as funders to be able to make sure that the type of funding they're offering actually really works for the organization. Because impact investing only works if the entrepreneur is dedicated to the social impact and is collecting data around the type of impact that they are having. And if the investor is committed to the social environmental impact and is collecting data around the impact that they are having. And that's where, and then using the right type of funding opportunities, whether it's debt or equity or other types of equity-like debt. So you can see, I'll just, for my last little bit here, just show you, this is also from the book, some of the different options around funding beyond just traditional venture capital. So for instance, philanthropic funders have the opportunities to use things like recoverable grants or forgivable loans that help them to engage with organizations that are purpose-driven. They can also use something called impact-linked finance, which allows them to change the cost of a loan based off of the impact that the organization is having. Companies that can use traditional kind of secured debt if they have invoices or purchase orders, using things like invoice factoring and purchase order financing and supply chain financing can be useful from a working capital perspective. Revenue-based financing is often an underexplored option for most founders. Venture debt can sit alongside venture capital debt. There's also things like what I have termed convertible revenue-based financing and redeemable equity. And I'm happy to go into any of these different types of structures during the question and answer as well. So what I would love for, I'm sure we'll get into some really interesting discussion now, but I'd love for everyone to take away is that impact investing is really focused on using the right type of measurement and the right type of data to be able to make investments into impactful organizations. But realistically, we need to be thinking about how we're allocating that capital as well as to what we are allocating that capital. So I think, Karen, I'll turn it over to you. There's lots of questions here that I'm sure that I will get to answer as we go, and then hopefully we can invite people to ask these questions too.
Thank you so much, Aunnie. Very intriguing, and I'm sure the audience have many questions, but let me start with this one. You know, most of those who work in the social space understand how difficult it is to measure social impact. And, you know, as you said, the social and environmental impact are what mainly qualifies an investment to be an impact investment. I know there are plenty of methods and institutions that work on measuring social impact, but from your own experience, what's the most effective or reliable way by which impact investor can quantify and qualify impact?
A very good question. I'm just going to actually share my screen as a little bit of a cop-out because there is no one way, but I can give you, I've put together a little overview of some of the different ways. So I'm just going to share that. All right, here we go. Where did this go? Got too many screens opened up. Okay. Sorry, don't know what's going on here. Here we go. I'll do that. There we go. All right. There we go. All right. So this, I think, is a great overview of the measurement space. So what we have now is we have principles that have been put together. So like the operating principles for impact management and UNPRI. These are essentially, so on the left-hand side are essentially principles that funders are signing up to say, you know, I'm going to follow the operating principles for impact management, which essentially says that you have to have strategic intent. If you are an impact investor, you have to manage your portfolio based off of impact. You have to exit based off of impact, and you have to have a independent evaluator evaluate that. So you can, if you're interested in those, you can go to impactprinciples.org. You can see the operating principles for impact management. So investors essentially sign on to those principles, any of those principles, and then we have standards of practice. So these are ways in which you take these principles and you say, all right, how do you manage your portfolio based off of impact? And things like the SDGs, the SDG impact standards, which is a useful set of tools that the UN has developed around impact investing. The impact management project, which is the dimensions of impact, is very useful. I would encourage everyone to check out these websites, including the impact management project. And those use metrics. So you may have seen there's been some big announcements recently about some of the impact and sustainable accounting around comp. So we're starting to have a more standardized language around business reporting of externalities. And then as well as impact metrics like IRIS. And so those are the underlying metrics. So what I see as being really useful is having investors that have signed on to something like the operating principles for impact management, and then are using, for instance, the IRIS metrics that link into the SDGs and the impact management project to be able to collect the data, the ongoing data, that they're able to evaluate the companies as well as their portfolio.
Thank you. This is very interesting. I will ask another question and then we take some from the audience. Only in one of our webinars, we hosted a representation from impact investment team in one of the very big philanthropic foundations. And a very interesting point came up, that some philanthropic organizations invest in projects that yield them a market rate return, right? So we were just wondering, why would a business that is capable of, yielding a market rate return be interested to explore funding options from philanthropic foundations? For example, do these foundations have more risk appetite? Are they more patient? Also, if you could talk a bit about the role of philanthropic organizations, if any, in supporting impact investment. Thank you.
Yeah, of course. So philanthropic organizations have a huge role to play in impact investing. So you think about different, so one of the ways in which the philanthropies can be involved is through investing first. So sometimes a lot of these, whether it's an organization or a fund, look very risky. So this is something we call perceived risk. So anytime someone's doing something new or maybe in a market that's not used to it. So one of the things that philanthropic investors can do is they can invest early. And by being an early investor, they actually signal to the rest of the market that this is, something that you should look at. Another is by coming in to provide some sort of risk mitigation. So doing a guarantee or what's called like a first loss facility to be able to help the rest of the investors feel comfortable, or by doing below market investments. Now your question, why, if a company can make market rate returns, would they engage with this? It really depends on the organization. So for instance, let's say you are a fintech organization. So you're providing loans and savings account and microfinance or microinsurance products to individuals. You may have very traditional investors that are pushing you to grow at all costs. And that may work for you. Or as a founder, you may want to be very committed to making sure that you're creating positive outcomes for the people that you are engaging with, and even that you are able to engage with people that are poor, that are of more need of your services. In that case, engaging with impact investors and potentially with a philanthropic investor that's able to help you to, in some cases, potentially even subsidize some of that reach out to go poorer, more rural, being able to maybe invest in having more female, let's say, agents in your network that you're working with. So there can be ways in which you can link the type of impact that you're trying to create, because there are lots of opportunities that we can make market rate return, but there are going to be opportunities where it's not possible to make market rate return. And so by linking in financial institutions that don't need a market rate return, it may allow us to reach people that are more vulnerable, that would otherwise be excluded if we were only looking for a market rate return.
Thank you so much. Aldert has a very interesting remark or question. Aldert, if you want to unmute yourself and address your question directly to Aunnie.
Yes. Good morning, good afternoon. I think I'm unmuted now, right?
Yes, we can hear you now.
Great. All right, great. First of all, thank you for the interesting sort of kickoff of this session. It's great, and I think you touch upon so many topics that it's almost hard to pinpoint one question to ask. But I think one thing that stands out for me is that a lot of times these discussions talk about institutes, organizations, impact investment companies. But I think what we sometimes forget is that in those organizations, there are people who are doing the job. And therefore, it's not probably about changing the organizations, but it's about changing the people who are doing their job. So therefore, what if we change the word impact into just our common sense? What would be, from your point of view, what would be required to get this common sense into people's mind of developing a policy or developing a portfolio strategy into, well, basically our common sense of an economical or an ecological point of view, and therefore move away from the conventional economical theories?
Aldert, I agree with you. I think it all comes down to incentives. So what we need to change is, whether it's common sense or it's impact or it's sustainability, we need to change the incentives so that individuals are incentivized to create impact, to fund organizations that are creating positive social environmental impact as opposed to just positive financial returns. And so I think I sincerely believe that individuals only do what they're incentivized to do. People don't do much out of the goodness of their hearts, really. And so it's about changing incentives. It's changing incentives at the individual level, at the corporate level. And I think that we can talk about, so there's personal compensation incentives. So there are things like changing to something called impact carry, which means that if you're a fund executive, you get paid based off of your social impact as well as your financial return. But then others are incentives that are happening in the market. So regulation is an incentive. So there's certainly regulation that is happening. There's also pressure from consumers for corporates to do the common sense, the right thing, treating workers correctly, supply chains. So you're getting pressure from the bottom, from consumers up. You're getting regulatory pressure down, and then investors also are, starting, particularly long-term investors like pension funds and others, are certainly starting to pressure organizations to be more transparent and to act more in the more common sense, common ecological sense. But also I think it's the reason that we can't say common sense is common sense for today is very different than common sense for 100 years from now. So if you're thinking, I think one of our biggest issues is not necessarily not common sense, but it's short-termism. So what's good for you today, tomorrow, and the next week is probably not good for your children in 100 years. And so how do we get people to be incentivized to do what's best in the long term? And that really comes down to incentives. And it's important for us to think about the incentives that we set up in policy, in companies, you name it. So I completely agree with you in that regard. It's people make choices.
Yeah, people make choices. Thank you so much, Oni. Oni, let me ask you a question and then we take another from the audience. This is a very interesting thing. When I was going through your bio, you are a founding member of Female Angel Investing Group, right? If you could talk a bit about the gender inequality in the impact investment space. Do women entrepreneurs get less capital than their male counterparts? And also, are there enough women in the position of allocating capital, or this is something that we need to work on?
So I can just answer the very short answer to your question is no. No and no and no. So based off of some recent numbers, I'm just looking up to make sure I get these numbers right. But in Africa, in the past, I'm just looking to see, I think it's been this year. Yeah. So in 2021, female-only founding teams have raised less than 1% of funding for African startups. So no is the answer. And also just to say that that's part of that reason, as you said, is because we don't have enough female investors, whether they're angel investors or sitting on VC funds. So I refuse to believe that women only make up 1% of the talent, right, of startups. So there's still a huge gender inequity, and I think it's, one of the things we see, and we've seen in the research, is that men in pitching, men are much more likely to be asked how they're going to succeed, and women are more likely to be asked how they're not going to fail. Very subtle difference, but it's a burden of doubt that's placed essentially on female entrepreneurs.
Thank you so much, Oni. Vinat Sharma, if you can unmute yourself and address your question directly to Oni.
It was a great presentation, Oni. So my basic question is regarding this. I mean, the impact investing is very much, a lot more concerned with the large players, or for that matter with the startups, which PE firms, but it is not able to make impact on the small businesses, informal businesses, and unorganized sector, which basically occupies a lot of, industry and lot of, developing markets, developing world, where nearly 90% of the people are in the unorganized sector. So how do you, intend to, make an impact effect through that? Because a lot of the consumption that is done, for example, in the the smartphones, we use the apparels sector, or for that matter even the automobile sector, tech sector. Basically, although it looks very good that okay, that they are environmentally sustainable, but the labor, the way the exploitation is done in the developing markets, and the way the complex supply chains are being misused in fact, and everything is completely is clumsy and cumbersome. For example, the deforestation taking place in the Brazil, and even the regulations. For example, even last month itself, the Brazil has come up and said that there's a protectionism as far as this deforestation is concerned, and due to which I mean the lot of products that are going to be there will be I mean there will be protectionism from the advanced economies because of these regulations. So how do we bring the synergy as far as this is concerned? Because even the Glasgow summit was all about this, that there's so much I mean things look very good as far as the conferences are concerned, but when it comes to the practical aspect of it, things basically take decades to take shape. So how can impact investing not be a just a fanciful idea, but can basically change the things on the ground? For example, this latest variant of COVID, which is making so much of impact, basically it's coming from the developing country like South Africa. So where I mean the vaccination basically can take place, and it will not be just a matter of few weeks. But where's the consensus, and where's the cooperation, global cooperation that we talk about, like we had in G20, in global financial crisis in 2007? So how can we, I mean, basically deal with these things in an expeditious manner? So thanks very much.
I'd just like to clarify that the latest variant probably did not come from South Africa. It was probably actually came from Europe, but we just sequenced it before everyone else did. So just to clarify that. So it's a really good question. I would say not just impact investing, but just global finance has worked for large companies, not for small informal organizations, businesses, and even formal small businesses. It glaringly does not work for most businesses. So I completely agree with the premise. For me, this was really the motivation behind writing the book, because what we think of, as you said, private equity funds, startups, we think of risk capital only being available for companies that are promising to be the next Facebook. That means that we only have risk capital available for a very small percentage of businesses globally. It doesn't make, the proportion doesn't make sense. So we really need to broaden our view of what does risk look like? And what types of structures do we have that are useful? So, for instance, you mentioned supply chains. I think being able to better use financing options like supply chain financing, whereby corporates provide working capital to small organizations, or even things like purchase order financing, where small informal organizations can use their orders from customers to access working capital. Those are two ways I think that we can help bring in informal organizations into a more formal financing system. And if we do it from an impact investing perspective, we can try and do it in a way that's affordable and accessible to those organizations. Because there are ways to take, I would say, some of the different types of commercial funding that historically has only been available to large organizations that are that can prove they can qualify for it from banks. And we can push this into areas that historically, like informal businesses in emerging markets, that have historically sat very much outside of traditional kind of financial. And this is going back, Kariman, to your question about philanthropic organizations. So, part of how we do this is we create blended structures. So you have some philanthropic capital alongside some commercial capital, and then the blended rate of return actually makes sense. Or you invest into some of these fintechs that are using, Vinette, you mentioned mobile phones, using mobile phones to be able to offer financing, affordable financing to informal merchants, to be able to better access their, again, working capital. So Vinette, I think what we need to do is we need to think about how to make financing smaller. So we need to be able to do, very small amounts of capital, but not just that. We have to make it very appropriate, and we have to rethink how what risk looks like. And if we can layer in some of this philanthropic capital to be able to really push out into these kind of areas that are underserved, completely underserved, then that's how we bring small, tiny, informal traders into the market. And I think it has to focus more on very appropriately structured debt instruments as opposed to equity investments that require those businesses to get quite big. And I think that's just been something that we haven't been able to do well in the market. And corporates should take some version. It's not just investors that should be bearing all of this. Corporates who have big supply chains need to be reaching out and financing some of these organizations as well to be able to make sure they have resilient supply chains. That's my opinion.
Thank you so much, Oni. Dr. Ali, would you like to weigh in?
Yeah, sure. Thank you. I have a comment, a question. When you look at most of the problems, the complex problems we have, they require a systemic change or an ecosystem level change. And this is a huge fixed charge. And no individual finance commercial entity will do it on its own. It really has to be led by the government. I mean, changes, there is a huge nonlinear change, and that's typically government driven. And then you have linear changes, which is basically tweaking, and that takes forever. It takes lots of money, but each one of them is small compared to the other one. So the role of government is just tremendous, and it's often missed. I'll tell you one thing that I've learned recently. The Moderna vaccine was actually an investment or whatever you call it, support from DARPA, which is the defense agency. Mm-hmm. The US has been subsidizing Elon Musk tremendously. The interesting part is that you look how they spend the money, and the US is more open than the rest, and I'm sure it's the same sort of irrational behavior from governments across. But I mean, let's face it. I mean, there is a certain entity that has to be done if you want to jump, if you want to transition all of a sudden to electric cars. Excuse me. I mean, Elon Musk is not going to pay for this. I mean, it's the government that's going to pay for this to put the infrastructure. So I want to get your point of view about this. We never talk about the role of the government, even when you think about commercial, they play a major role. This is one thing. The other thing, I was listening to a speech, Muhammad Yunus. He was a guest speaker of an inclusive business Sweden, which is part of the BOP Lab network, which we are a part of it also. He's been promoting 3 zeros, unemployment, poverty, and net carbon. And he was saying bluntly, do not depend on business to do it. The only way to do it is through government and through civil society organizations, community. He was saying that the businesses in general, I mean, you could have a little bit heroes there, but in general, as a mainstream, as a bulk, they're not going to go this direction because and they're going to resist it. So I just want to get your feel about this, or your comment about this. Thank you.
Yeah, of course. So I think, I agree with you. Government's always part of the equation. And actually, I would say impact investors probably do speak a bit more about government than normal investors, just because we are often looking at things that are systemic. So I think there's 2 roles, though, of government. Part of it is, of course, providing some of the ancillary services and seeding investments, et cetera. But then there's a big piece of government that's actually creating and enabling infrastructure. So we've done quite a bit of work, and I helped years ago set up the National Advisory Board here in South Africa for impact investment. And, one of the first things that board did was, really create a roadmap for policy changes. And the Global Steering Group, which I can put the link here, the Global Steering Group, which is head by Sir Ronald Cohen, has really been focused on how to get governments on board and public policymakers, because there's absolutely, as you said, there's absolutely a role to play. So whether it's tax incentives, enabling legislation for companies around being incorporated as useful types of incorporation for businesses, investors being able to understand legal and regulatory issues. So there's a lot government can do. If you look at examples, tangible examples like the like Big Society Capital in the UK, which is essentially a fund of funds, an investment fund that invests in other funds. That's partly government money, partly money that was coerced from the banks at a very low return. And that's been incredibly catalytic in the UK. And there's been multiple of those funds set up elsewhere. So government can provide resources into impact investing. They can create and to create impact, as you said, systemic changes. So I think, I mean, absolutely, government's a huge piece in this. I do think that there are times that government plays a great role in enabling private organizations to actually provide services. And there are other times that government does a great job of actually providing those services, and sometimes being able to recognize which is quite interesting. And then, yeah, on the thing of, I haven't heard, this must be Muhammad Yunus's new thing. I haven't heard this yet. I so respect him and look up to him. He's one of the reasons I got into the space originally 12 years ago. I was reading one of his books that really changed my life. And I do think in a way he's right. I think the really radical changes are really outside of large corporates and businesses' control, because they are not incentivized to completely change the system. So this is where I go back to, as Albert summed up in here, the tripod of government, privates, and consumer sector and consumers. So, and then we can maybe add a fourth leg, which is civil society and nonprofit organizations. But I do think that there is a role for each of these types of organizations and individuals in trying to get to the 0-0-0. Yes, some will come more willingly than others, but I think it's about creating transparency, so radical transparency for us to be able to judge the types of products that we buy, the types of companies we invest in based off of their commitment to, real radical goals, and then also regulation that requires them to do that. So I think it's, we talk about incentives, right? So I think you need regulation that requires companies to be transparent about where they are and what they're doing, with otherwise at risk of significant liabilities or damages, and then allows consumers and others to make choices based off of that transparency. So I think as much as there's the yes, I agreed, Honey. Yes, I think the civil society and NGOs have to be a part of this. Absolutely. But I do think that I think we negate the power of large businesses at our peril, and large financial institutions at our peril. So governments are a huge piece of this. Nonprofits are a huge piece of this. But actually, if you think about corporates and large financial institutions, if they are not part of the equation, it's going to be a lot slower in us being able to get things done, even though they are often very kicking and screaming and coming along the way. So I think it'll be a combination of push-pull. So push by consumers and investors, pull by government and regulation, and then it just will require radical transparency, in some cases some radical legislation, I think. Wow, there's a couple of good questions on the side here.
Thank you, Aunnie. Robert Lowe, could you please unmute yourself and address your question to Aunnie? Robert?
I think Robert wants to tell me how to put money to work. Wants me to tell him how to put money to work. Is that right, Robert?
Could have been late. Let me unmute for a while there. Yeah, that's exactly right. I'm a little guy in individual investment, and wanted to ask if you could walk me through very concrete steps for how to participate in this space.
Yep, absolutely. No problem at all. It's a great question. So I would say there's a couple of things that you can do just off the bat. One is you can look up, I don't know, Robert, which country are you in?
I'm in the US.
In the US. Okay, well, then that's very easy. In the US, there's a multitude of crowdfunding platforms so platforms like Republic and WeFunder that allow you to do crowdfunding. You can do as little as $10 or $15, and there's plenty of those on. So I personally use those too. And I only invest in things that are aligned with my own impact. So you'll see that there are themes on those. Almost all of the crowdfunding platforms globally allow you to invest in things that have a positive social impact. The other way in which I layer it in is I only invest in women founders and also founders that are people of color. So that's part of how I also have my own impact, Robert. That's one way. So there's crowdfunding platforms. There's a whole variety of crowdfunding platforms globally. Most do offer opportunities to do that. Another way is through public equities. So again, there are platforms out there that allow you to invest in ETFs that are around impact and other sector opportunities, to have bonds that are green. You can speak to your financial advisor that can and talk to them about ways in which you can layer in your values into your portfolio. And then thirdly, what I would encourage people to do, and often people think this is way outside of their own bandwidth, but think about angel investing. It's not, so for instance, the angel investment fund that I helped start here that Karaman had mentioned, we put in a relatively small amount of money each. So it ends up being the equivalent of about $10,000 each over a period of time. And we invested that together. There were 20 of us that invested that money together over a few years, and we're hopefully going to do that again. So angel investors write checks anywhere from $500 to $10, $100, $200,000. It's really great to do in circles and groups. And if you look up, Robert, there are angel investment groups in every part of the United States. There's angel lists. There's so many opportunities to get into angel investing, even with just a few hundred or a couple of $1,000s. So those are my three ways to do it: public equities, crowdfunding, and angel investing.
Thank you very much.
Thank you so much, Oni. Jacob Baldwin, if you'd like to unmute yourself.
Hey, Aunnie, thanks so much for sharing and all the great insights. I was curious if you could share just a few more examples of those you feel have really figured out that better how in the third phase of impact investing.
Yeah, absolutely. It's a good question. So I would say the examples in my book are definitely some of the good ones. So some of the funds that I have a lot of respect for include funds like Adobe Capital in Mexico. Here in South Africa, there's a few that I've worked with, like Kona Capital, for instance, and Knife Capital. In the UK, there's also some that are, I would say, from an impact perspective, like Bridges, that are little Bridges Ventures that are, very much at the forefront. Then there's also firms that are doing more of the intermediation that are interested in this innovative financing space. So Roots of Impact, for instance, and based out of Germany, but that has operations globally, is really helping companies to be able to think more creatively around their structures. And then there's some family offices that have just done an excellent job. So for instance, Blue Haven, which is a family office that invests in Africa, et cetera, the principal, Liesl Pritzker-Simmons, just really been very thoughtful in how they allocate capital. So those are off the top of my head. There's lots more, but those are some of the ones off the top of my head.
Excellent. Thanks so much.
Thank you, Oni. Thank you, Jacob. We have another question from Samar. Samar Al-Shurfa, if you...
Oh, Samar wants to know about raising funds for social enterprises. It's a good question, Samar.
Yes, hi. So I run a business that obviously I am struggling at the moment. I wouldn't say really struggling yet, but I have started, attempting to raise funds for my business. And I think it's quite a challenge. There's, on the one part, it's not really understood. Like when you speak to angel investors here, yes, they might claim that they would like to invest in impact-driven businesses, but they really, at the end of the day, look at the profitability, and they have a very capitalistic or capital-driven approach to their investment decisions. And I see that you're a big fan of crowdfunding. I don't know if this would be a recommendation, but I'd love to hear your thoughts if there are like best practices. I would like to second Dr. Ali Aunnie, though, about his comments regarding policymaking, because I really think that in the region at the moment, what we have is a very fragmented ecosystem. There are amazing individual initiatives, championed by the individuals who run them, but unfortunately, it doesn't all come together very cohesively for social enterprises. So love to hear your thoughts on this.
Yeah, so Summer, I've just put a link in the chat. I have been asked this question so many times that I've put together all of my thoughts and links in one place. So you can click the LinkedIn thing. So it's called, so you're looking for to raise capital for your social enterprise. So I've got a bunch of like ideas in there, way more than I could tell you in 3 minutes on the webinar. But I think one of the things, and also the reason I wrote the book, I've also put my the book website there that has a bunch of additional resources around kind of thinking about the types of capital, because I do think one of the reasons, Samar, that it can be very difficult to raise capital is that you, for instance, may not be the right candidate for equity funding, but you may not know what other types of risk capital there are. And so if you're going to talk to equity investors, even if they're very impactful, if they look at your business and go, well, this is an equity investment, it's very difficult to meet that criteria. So I'd recommend looking at both of them. There's also some great resources within their links to other online platforms that are really useful. So I would say crowdfunding is an option. It's not the right option for everyone. I would definitely, and this is why I wrote the book, because there's just like there's a lot of great options depending on what it is that you're looking for. So I would, without trying to be too self-promotional, I definitely say read the book. There's lots of good opportunities there for like thinking through this question. And that's because it is such an important question that I get all the time. Awesome. Good luck, okay? And I'd just like to say, I love that Hani is also a micro angel. I think we need way more micro angels so that Samar, when she's speaking to people, finds more female entrepreneurs, more female investors that are willing to put the capital to work.
Aunnie, thank you so much for this great discussion, great insights. And it was very interactive. Thank you so much for making the time and effort and contributing this session. We really appreciate this, and we're looking forward for for deeper cooperation.
Sounds great. And I would just encourage everyone, do check out the book. There's a lot in there. I've also put up, feel free to, connect on social media. I post stuff all the time on Twitter. I'm Aunnie, so that's pretty easy. So you'll find me there. And also on LinkedIn, etc. So yeah, please do connect. And really lovely to see you. Thank you for the invitation.
Thank you, Aunnie, and thank you to the audience for the great questions and engagement. And I would like to invite you all to attend the coming webinar. We have another conversation also about impact investment. We're hosting Liv Palvis from Kiva, and he's going to lead a discussion around expanding financial access in the Middle East. He's going to focus on their work with the refugees. So I would love to see you all then. Thank you so much. Thank you, Aunnie, again. Thanks to everyone. and have a great day, evening. Bye-bye. Thank you. Bye-bye.